Before we start getting into the more formal remarks, thank you for being here. And feel free to get up and have a drink or if you need to stretch your legs. That's free, and then that's fine, and it's also free. And the other thing is, we are going to open this up for questions, and so someone always has to ask that first question. But I imagine that's not going to be too hard with this group. So I'm just looking at Emily. Do you want me to? She's saying, go. It is my pleasure to welcome you to this evening's panel on behalf of the Heller-Hurwicz Economic Institute. The Institute was founded in 2010 with the mission of informing public policy and supporting frontier economic research. It honors the legacies of two of great Minnesota economists, influential policymaker Walter Heller and Nobel Prize-winning Leo Hurwitz. So tonight, in honor of their approach, we're going to talk about building a better retirement system. And I think the topic is timely and critical with 10,000 baby boomers a day reaching age 65 until 2030. So how can we improve retirement security for the average American worker and household? So we have three experts with deep knowledge of pensions and retirement savings. I'll keep the introduction short, and to my left is Greg Mennis. He's Director of Public Sector Retirement Systems Research for Pew Charitable Trusts. Deborah Lucas is Professor of Finance at the MIT Sloan School of Management and Director of the MIT Golub Center for Finance and Policy. Kurt Winkelmann, from my far left, is Senior Fellow of Pension Policy at the Heller-Hurwicz Economic Institute at the University of Minnesota. So to start off, and I'll start with you, Kurt, and then we'll work toward me. Just, tell us what you're doing in terms of your research. What is the project that you're working on? Sure. What is the research that you've been doing?
So we've been focused on one very specific issue, which is how do you think about changing policy for public pension plans? I think many of us have read the headlines that public pension plans, to be succinct, don't have enough money. And we've read kind of stories about Illinois, Chicago, Detroit, New Jersey, many, many states where you look at it and go, well, what's going on with funding public pensions? So our project is focused on taking a step back and saying, well, let's think about the constituents and think about the incentives to reach the constituents and think about changes in policy that could possibly make each of those constituents better off. Now, when you think about public pensions, there are two constituents, taxpayers and beneficiaries. So the question is, can we design a policy that would make beneficiaries better off and potentially make taxpayers better off? And it turns out that when we set it up, we can devise such strategies. So that basically says that we increase wages for public employees, but convert them to a defined contribution plan. And the benefit to taxpayers is that they have less volatility in terms of possible tax payments. So we actually spent a long time thinking through how to set this up, and then thought, well, we should try this with an actual reform, with a state that really did something. So it's not just a purely random exercise. And we picked a state that Greg has actually done work with, Rhode Island, where I, at least for the next month, still live. And it turns out that specific reform that had those elements winds up being welfare improving for both taxpayers and beneficiaries. So that's it.
Okay, well, that's a lot. We'll have some follow-up questions to that.
Yeah.
Debbie?
Good. So to follow along on that line, my center recently ran a contest on how to build a good, what's called a collective defined contribution plan. The idea of collective defined contribution plans is to combine the best of DB and DC for public sector workers. So the idea is that it is DC in that the risk ultimately is on the workers and not on the taxpayers. However, you want to preserve the best features of a DB system. And so you have a centralized management of investments. And importantly, you have a reserve pool so that in periods where there's very high returns on investments, Those kind of very high end of the return gets swept into the pool. When things don't go well for a while, the low end is used to give people a fairly stable benefit. So most people don't want to have to think about, will my retirement be great or horrible depending on what happens to the stock market. They want a kind of a predictable stream. So the trick is to set up both an investment policy and a distribution rule where you can say to people, in all likelihood, you're going to get at least this replacement rate on your salary. And so that kind of a plan has been tried successfully in some Scandinavian countries. New Brunswick in Canada is trying that out. So that was one idea. And then in my own research, as a financial economist, I was kind of curious. So that reserve pool, which I'm saying helps buffer fluctuations in the market, is a way of really having insurance across generations, if you will. Because, I'm kind of curious, and working with a student, I'll tell you the answer when I know it, of to what extent can you kind of reproduce that even in a plan, someone themselves, by using options to, buy, basically sell calls and buy puts, which is kind of a self-insurance that cuts off the tails personally, and how much are you really getting out of that reserve fund. But anyway, we've built a tool which we're hoping, with the help of people like Kurt, to bring to different states or localities to try to help planners see what they can accomplish in this kind of a system. I'll leave it at that. Okay. We're doing other stuff too.
Greg?
So our project at Pew does two things. One, we do 50-state and multi-city comparative research on all facets of public retirement systems, from funding to investment policy, benefit design, retiree health care. And the second piece is that we provide technical assistance, essentially consulting directly with cities and states, looking to implement reforms to address their underfunded retirement systems. We've done that in over 20 jurisdictions, working for Pennsylvania, Connecticut, New Jersey, and providing that kind of support. I think that the problems of underfunded systems and the impact that it has in crowding out government services is pretty well understood. But one of the things we've been turning our attention to more recently is the well-run retirement systems. And this has been a really interesting exercise, and I think builds a lot on what Kurt and Deb have been talking about. And we actually just finished a pretty cool preliminary analysis where we set predefined criteria. Basically, do the plans provide a path to retirement security across the workforce, not just for a career employee that a public pension typically benefits? And is there a plan for uncertainty to protect the taxpayer? And it was a really interesting analysis that actually kicked out 3 state systems and a total of 5 plans, and it runs the gamut from a defined benefit to a hybrid to a defined contribution plan. Wisconsin, Tennessee, South Dakota, Nebraska, and Utah were the states that really passed the test on both fronts: retirement security across the workforce and a plan to protect taxpayers from a risk perspective. And so I think that's something we're trying to introduce to the conversation a little bit. I think you can only talk about unfunded pension liabilities so long before you get asked to leave a cocktail party. So we're trying to bring some good news to the conversation.
We'll let you stay.
Thank you.
Okay.
Appreciate that. Yeah, thanks.
So Kurt, the topic is building a better retirement system. So what have you come to decide are really the key or keys when you're building a better retirement system? And there's lots of things you can always do at the margins, or this might think, but what do you now think is, here are the key points if we're going to be building a better retirement system we need to focus on?
Okay, so I'm going to quote somebody who came to our conference in Minnesota in January.
A brave soul.
What's that?
A brave soul.
Yeah, he's Swedish, so. It's kind of funny. He's Swedish. And he works in the Netherlands. I called him up and said, "Hey, Stefan, do you want to come?" He goes, "Yeah." He says, "I hear there are a lot of Swedes in Minnesota." I said, "Yeah." He goes, "Oh, I'd love to see it then." So it's okay. Well, come on down. Come on over. But anyway, his point, which was really good. It's like, this is not that complicated. We make it complicated, but it's really not that complicated. You have to put enough money in. You have to have a proper investment policy to invest it the right way, quotation marks. And then you have to have a kind of some rule for how the assets get used in retirement. Now, what we've managed to do, of course, is put in a bunch of barriers that, depending on which constituency you're in, doesn't really deliver on the promise. So, for instance, and Greg and I were talking about this earlier, if we think about the people in, actually we were all talking about it earlier, so if you think about people that don't work for large companies,
Right.
Or who aren't in high-paying jobs, even below median income, well, how are they solving that problem? And the actual mechanisms in place to do that, I would say, are basically not there. On the other hand, if you are one of the 4 million taxpayers in the United States, 4 or 5 million taxpayers in the United States with $1 million in financial assets, you're fine. You're going to get advice. There's some variability in quality, but you're going to get covered. It won't be a problem. So it really depends on what group we're talking about,
Right.
and what incentives are in place there for either government agencies or private entities to work on the problem.
And Debbie, I was just following up what you were saying. MIT has this, at least a number of the economists at MIT that I've talked to, they have this sort of, I don't know if it's an ideology, but a belief that you can do financial engineering for good. Andrew Lowe, financial engineering in biology, for example. And, it's a really attractive, so when you're talking about, using puts and calls and creating like an insurance product. Okay. But then Kurt's talking about making things simple and for the average person. So how does that financial engineering to improve things, how does that actually work?
Okay.
Do you
Yeah,
know what I
thank you
mean?
for that question, because I'm very happy to answer that question. And I always channel Bob Merton, who sits 2 doors down the hall from me, who's very involved
Nobel
with
laureate.
the whole Nobel laureate. At MIT we call it Black-Scholes Merton options pricing formula. So we have an extra letter in ours. I think his vision and mine too, when I think about financial engineering to help the world, is you don't need to teach everyone to be a financial engineer. We don't teach everyone to be an engineer. Our houses get built, we don't build them ourselves. And so the trick is to design products that have these features built into them where people don't have to make individual decisions. And in fact, our current system, a shortcoming of our 401k focused system is it actually is forcing people to be their own financial engineers,
That's right.
and a lot of them aren't good with a screwdriver. So you're getting a lot of people who are making a lot of noticeably mistakes. You can have different views about how much risk you want to take, but there's a lot of people who are clearly not optimizing, and they're not getting much guidance, partly, as we all know, because of the rules, because we set up a system where employers really aren't supposed to give advice, and then the advice that's out there is all over the map. So more affirmatively, so just to give you an example of what Bob himself is thinking about, what he thinks, and I also agree on this, is there's been too much focus on having individuals think about the accumulation phase of retirement rather than a focus on what kind of income streams they need in retirement. And that can be quite different across different people, depending on their family situation, whether they think they're still going to be working, and so forth. And so I've heard it from him and also from others that what you really want is to find a new way to talk to people to elicit their goals, and then basically tell them, well, this is how much you would have to save to achieve that goal. And then in the middle, though, you have an investment strategy, which is, they don't have to understand all the details of that. So that's where the financial engineering under the hood comes in.
So if I can follow up on that.
Okay.
I love the idea.
Okay.
However,
Okay.
so the practical thing, so the first question is, well, how do you get it right through the regulatory bodies to make it an actual viable product? And that is not trivial. The second thing is, okay, now you got this product, and this gets to the communication issue, actually. So you got to, who's going to sell it? And if we're talking about the advisors themselves, so if you go to the financial planners and financial advisors, they won't sell stuff that they don't think they understand, which is which means they shouldn't sell a lot of stuff.
That they do.
But because they think they understand it, but they actually don't. Then I think if you can get the product designed to the extent that it can become a default option of large corporations in some way, then it becomes, in my mind, it becomes more viable. In the same way that that the target date fund is now in many plans a default option. Actually, if you could hook it with the target date fund as the default option in a large firm, that might actually be a viable sales strategy. But I like the idea.
Right. I mean, I think of the collective defined contribution as kind of along those lines,
Yeah.
which it's trying to professionalize the management
Right.
of the assets and still give people kind of an income stream that they'd like. I think it's kind of which devil are you more afraid of?
Right.
Because, you know, the public sector systems, as we're talking about, are not funding adequately. And so do you want to do it through the private system?
Right.
And a collective defined contribution?
That's usually in the public space, not in the private
okay.
sector space, because it's harder to do, I think. You could do something like it. That's my interest in the options, is actually partly how could you take that same idea and do it in the private space with less redistribution, because it's harder to redistribute in the private space. I can mention it later, but I was going to say an example of what you're talking about, which is the regulatory difficulty. Another thing that we're thinking about a lot is reverse mortgages.
Right.
So that if you look at, a striking statistic is that if you look at total financial wealth, for one thing, you know, people have almost none of it below the top 10% of the wealth distribution, you know, so it just falls off to zero. So most people don't have any financial wealth to manage. Whereas housing wealth goes all the way down to the 50th percentile. And there's a lot of money tied up in people's houses, and how people can get at it and integrate it with the rest of their retirement planning is a huge challenge. So as far as I know, no country has been that successful at designing a good reverse mortgage.
Right, including this one.
And clearly this one has been particularly not good at it. And in the way of unfortunate bad American inventions, other people are picking it up. So I'm going to Korea, in fact, next week to talk to them about their reverse mortgage, which copies the US market, which has not worked well.
So Greg, I know that underfunding is your favorite topic,
Yeah.
but I do have to, so is the underfunding, when we're thinking about the underfunding with the public pensions, is that endemic? Is that like inherent, that's built into the process? For example, there was underfunding with private pensions when they offered defined benefit plans. And you can't always say it was because bad. You know, we're going to invest in a new car or R&D or do this, or we're going to fund the pension plan. Well, you know, these other things keep things going. So is it endemic to the design of the actual product itself?
I think the risk of underfunding is endemic to the design itself, and that's in part because there is no perfect enforcement mechanism that makes the public sector employees put in enough money. And so what we've now also seen, though, is there's a growing disparity between the states like Illinois and New Jersey, Kentucky, Connecticut, Hawaii, that are now paying somewhere between 1 in 10 and 1 in 5 every tax dollars are now having to go to public pensions, because that's where the underfunding has happened, and it's such a difficult problem to work yourself out of, and we know we can't invest our way out of it. But here again, I think there are the states, and I mentioned several of those before, that have about a 20-year track record of maintaining fully funded status, admittedly with aggressive accounting assumptions that are allowed for in the states, but have kept a very predictable cost as a percentage of revenue and done a good job for the participants. So I would say that the risk is absolutely endemic, but no, I don't think it's going to happen every single time based on the numbers.
And what are those states that you see doing it right? What is it that they are doing right? I mean, is there a mechanism that could be copied by New Jersey or Illinois?
Yeah, the biggest thing is actually paying your actuarial contribution every year, which is something that New Jersey has famously done a poor job of historically. And then in addition to that is having this plan for uncertainty to protect taxpayers. And what that just means is you have a risk management policy. In Wisconsin, South Dakota, Tennessee, in every single instance, they have a regularly published analysis, and there are automatic stabilizers that adjust COLA benefits, for example, based on market conditions and market outlooks. So it's having those rules in place and following them every single year that really makes the difference. But again, what I think is interesting is when we've done that analysis and distilled it down to a very small handful of states that have this very predictable cost and have well-funded plans, it also turns out that they are doing the best job of providing retirement security across the workforce, I think because they can afford to. So I think it's interesting to see that the common characteristic is having this risk management policy, but it also happens to be that they're doing a better job perhaps because they can afford to do it now on the retirement security side.
Hey, Greg, can I ask a question on that?
Sure.
So how long have they been doing, how long have the policies been in place?
In the case of Wisconsin, for decades. I think Tennessee has a well-funded system, but their hybrid plan's only been around for about 10 years now. South Dakota, again, has been in place for quite a long time. The cash balance plan in Nebraska, the same thing. So these are pretty well-established plans. Probably the Utah and Tennessee are the two ones that have only been around for a decade, but we have 20 years of experience of predictable costs. So I think there's an argument that it can be done, and it's interesting to me that those designs are all different. The DB plan, a DC, a cash balance, and two different hybrid models.
Note that the private sector used to be heavily overfunded, then they changed the tax laws because it was a way to shelter income. So actually you can change the funding levels in the private sector by changing your tax rules.
So what did you mentioned your experience in Rhode Island, and so what did you learn from that experience about the public pension plans?
Yeah, so I won't talk about the politics because I obviously wasn't engaged in it. But what we did learn out of that is that the level of the increase in income, so kind of a certain income, actually I should go back to the reform, and Greg can correct me on this, but the basic reform is anyone who's worked for the state for more than 20 years, they keep getting the DB plan. Any new entrants gets about half of the old defined benefit, but they get a 6% increase in compensation, and that 6% increase has to go to a defined contribution plan. The default option, by the way, is a target date fund. And then there's this kind of a sliding scale in the mix between defined contribution and defined benefit. So what we learned out of that is that is that by introducing the defined contribution plan, that introduces some variability to retirement income. But the fact that there's a floor in terms of the defined benefit means that there's a floor in terms of how low retirement income can go. So which gets, I think, it's some of the features that Debbie's talking about in terms of a collective decency, in the sense that to make the whole thing work, you have to put a little bit of a floor on income, but there's a potential at actually doing pretty well.
So it was interesting that as there was an article in the Wall Street Journal last week that New Jersey is thinking about putting in a hybrid system. Now it's being pushed by Sweeney, who is the Democratic power in the Senate, but it would be, again, a benefit up to $40,000.
That's right, yeah.
Increase in pay, I believe. But anyway, the money would go into a 401k type instrument. So is this something that you're seeing?
It's a different variation on what Kurt described in Rhode Island. It's what is usually referred to as a stacked hybrid plan. And so to your point, they're preserving the defined benefit, but only up to $40,000 of salary. And then above that, it's a cash balance plan, which is an individual retirement savings account. So I think it has some of these same ideas of some minimum predictable level of income. I think it will reduce costs and reduce risk for the state. In this case, for New Jersey, we just have to go back to the fiscal challenges of how underfunded the system are really the first order of business. We ran a stress test. We have a stress test model that we apply using the Dodd-Frank adverse scenarios to actuarial projections. And New Jersey is one of only a couple states that literally fails the test and goes insolvent in downside scenarios. So I just bring that back around to say, kudos to policymakers in New Jersey for all the attention they're putting into it. I think this hybrid model is an interesting idea, and we're certainly supportive of the state being focused on anything they can do to improve the system. But ultimately, in that case, they just have to be putting most of new tax revenue to keep the system stable, and that's really the first order.
You know, one thing I'm just curious, I mean, my figure's slightly off, but it's like 85% of public sector employees are under some kind of defined benefit plan, and 85% private sector workers, you know, are in the 401k type plan, defined contribution plan. And if we're, for a moment, stepping back from the politics of the situation, you know, since it's all over, it's the same goal, and it's all tied to work, right? I mean, should we be working collectively more toward a single type of plan?
I'm not sure we should be working towards a single type of plan because I don't think we can agree on a vision, and I think the barriers to getting there are different in the public and private sector. I mean, I think what we should be thinking about is what our goals are on both sides and how to get there, and maybe that would get us some convergence.
Because part of what I raised is here, like New Jersey, they're doing
Right. The hybrid kind of
and then
idea.
kind of what you were talking about for, if I'm understanding you right, in a way
Right.
is a hybrid plan, you know, giving more certainty to the private sector worker, right?
Well, I think generally economists have been on the why don't people annuitize bandwagon forever, and they don't, and we haven't really cracked that nut. So maybe that's one reason I'm not quite willing to impose a single solution on the world. I am sympathetic to, so I am sympathetic to the idea that there's these common principles that should apply to both the public and private sector, which is we want to share risk in a way where the surprises get lower and lower as people age, and we want people to understand what to expect so that they can plan, and we don't want to be hitting walls either in the public or private sector. I mean, in the private sector now, there's huge uncertainty over the multi-employer plans. So, you know, we haven't talked about it, but PBGC is, you know, could go bust too because of the tensions in those multi-employer plans in the private sector. So we don't want to create unsustainability. We don't want to make promises we can't keep. We want transparency. I think all those goals are there for everyone, but at least I don't think we've come up with a silver bullet. I actually wanted to ask you what you think about the ideas for these states like New Jersey, where they have these terrible historical problems, whether there isn't some way of almost having a good bank, bad bank. You know, people have talked about that, but I just don't think you can do, when you do the aggregate accounting, it just looks terrible. So if you can't somehow say, well, this is this huge problem, but we should be able to take things and go forward without this as always an overhang.
I think that's so funny that you asked that. We were just talking about this yesterday, but I think from an analytic perspective, that idea of the good bank, bad bank applied to pensions makes absolute sense. We've been thinking about looking at the poorly funded and the well-run systems, and this idea of separating out whether they have a sustainable plan to finance their existing obligations versus what it looks like going forward. So I think that that's actually how we're thinking about studying the issue more carefully, and it's spot on. I will say from a political perspective, that's a really difficult conversation to introduce. Because even if you're just trying to draw a line between the obligations that you're on the hook for now and what it might look like going forward, it sounds like you're trying to just completely overhaul the system without doing the work. But I think that's spot on in terms of a way to frame it. And a question back to you, just because I think this is really interesting. In the collective DC, or does that allow for some measure of intergenerational risk transfer? And I ask that because we've been thinking about how to articulate the principles that work for systems where there is some risk being shared. And we're kind of struggling with, should we say manage intergenerational, mitigate, or something else as it relates to that?
Yeah, so that's actually also a great question. So in fact, in the solutions that people submitted to our contest, they figured out, and we figured out when we were playing with the model, that what you can tweak has to do, it's almost like a dynamic control of the reserve fund. So when the fund is starting to shrink, you can change your investment policy, but you can also change your distribution rules. And it's the fund is the mechanism whereby you're sharing things across generations. So, you know, when it starts to go down, you can increase contributions a little bit more, you can reduce benefit well, not on people who are already retired, but you can kind of bring down what
okay.
you're promising. And that mechanism is, in fact, sharing risk across generations. So the reason actually I didn't say that you could do this in the private sector is there's just a stronger sense of property rights there. So I think it might be a little bit more difficult to try to do that kind of intergenerational risk sharing in the private sector.
So it allows for, but manages it, of course.
It allows for it, it manages it. There's a lot of devil in the details. So for instance, there's a question of when you vest and then what do you get before you leave. Because in these kind of collective systems, if you're not very nice to the people who leave early, say that you only let them keep their own contributions plus the risk-free rate, they're in a bad situation, but it's very good for the collective pool. So, and I think, that is a way, in fact, that some of these systems probably are already trying to claw back, is by treating, well, I know they're treating younger workers badly, and they're treating separators badly, and that's not a good solution, but it does partly deal with the problem. So you have to be very careful in the design of these things. You really, to me, what I got out of creating the tool is I actually think you can also use it to talk to unions and to talk to workers and say, like, this, let's simulate it through, and this is what you're actually going to get.
Yeah. So I want to make a slight shift of topic, Kurt, with, particularly in the private sector, we've had 25 years where I would say the coverage of the 401k has been dominated by wealth accumulation. What's your asset allocation? How much should you have in stocks? How much should you have in bonds? How much should you be putting in when you're in your 20s, your 30s, the whole thing. And it's pretty complicated. It's really complicated taking the money out and the stream of income that you're supposed to be living off of. And for most economists, the answer is annuities. And to most people, the answer is, huh? So how are you looking at this stream of income when people are in retirement because they've accumulated these assets? How do you deal with that?
Well, so you have to segregate this into two groups. So if we start with the people that are seeing advisors, that's one group.
That's what.
So what?
But I'm thinking like the cubicle worker.
What's that?
The cubicle worker that, it's got a 401k.
Yeah.
Their advisor is their neighbor.
Well, so the advisor community would say, okay. So their neighbor would say, well, you should see my financial advisor. He or she is great. So let's start with them. And I'll work with the advisor first, and then I'll kind of go down to the individual. Actually, before I even do that, so the advice that they get on that is terrible. So we'll just start with that.
Right.
So let's take the person who is trying to evaluate the choice of being self-insured. So in other words, managing their own money through retirement and figuring out how much to take out, or buying an annuity. So, I think we've agreed economists love annuities. I think we've also agreed, I'm pretty sure that most economists think that annuities, the actual market pricing is not so great. So if economists can look at that, that's good. If they can't figure out what to do, that's not so good. So how does a cubicle worker figure that out? So the odds are pretty good they're going to try and use an advisor to make a determination for them. Okay, so the second part is, well, okay, what's the advisor going to do in terms of advising them? And there, if you look at the actual analytic tools that are available to them, I think the most succinct answer is they're terrible. So a friend of mine was kind of showing me some stuff that somebody had done. And the reality is it still punts the decision back to the end investor. So if you as the end investor believe that equity returns are going to be X, then you can do Y. If you believe it's going to be something else, then you can do Y. So it still punts one of the key choices back to the individual. And the problem, at least as I see it and talking with others, is that the regulatory structure is set up to almost actively discourage the advisors from taking a point of view on the most important thing. So the reason that target date funds have become so popular, at least one reason, is that it's a pretty well-crafted default option. Well, it's got problems, but it's nonetheless, as a default option, it's a pretty good start. On the decumulation phase, there's been no default option.
Yeah.
And the barriers to actually giving constructive advice are huge. The asset management firms don't want to do it.
Debbie?
I was just going to say that it's one of the interesting things that people are at least talking about with fintech. And so there is a question of whether, I know that that's just putting it down one level, but in fact, advisors are also expensive. So
Yeah.
apart from the fact that they give bad advice, it's expensive bad advice. So,
Yes.
I mean, the hope is that you could somehow create more trusted systems, and because you can do it at a large scale, but then people still want someone to talk to them. So I think
Yeah.
there's this interesting challenge. I don't know of a company that has successfully done it, but I feel like that's where the buzz is. It's like, how can you package good advice
Right.
and then get people to understand that it is good advice?
So I have two things I do, and in the other one, that's what we're doing.
That's right. Okay, so you could say, do you feel like you can do that?
Yeah.
People are going to trust your robot?
Okay, so the robo-advisors. So my talent on robo-advisors is most of them are long robo and short advice. We are long advice and short robo. But yeah, our advice is pretty, it's credible.
So in terms of so Debbie, do you think that that there are going to be changes coming to the annuity market to start dealing with this? I mean, it was interesting where wonderful economist V. Boating, and he loves annuities. He loves inflation-adjusted annuities.
Yes, he loves inflation.
Right. So, and he wrote this wonderful article, why you should buy inflation-adjusted annuities. But there's only one company that sells it, the principal. That's it.
Right.
Which is hard to recommend something when you have one company in a market. So do you see action happening on the annuity side, or is this one of those things where it's going to be elsewhere, that this is actually not the right where the stream of income is going to be coming from?
I feel that the market that I'm most optimistic about is actually a deferred annuity market, because I think people like to retain control of their money in the younger part of their retirement, and when they really have to worry is as they get older, they lose the cognitive ability to manage money at all. I mean, those are really scary statistics of what happens to your ability to think about these things. So I think we should be pushing deferred annuities because they're not as expensive, and they do create that kind of floor of support when people don't need them. I know Zvi has been Mr. Annuity forever. He has a great book called Risk Less and Prosper is the name of his book. So he's a big proponent. I don't think we're going to convince people to buy annuities. We are seeing a lot more variable annuities, which I think it's almost like a CDC idea, which is it's basically saying, well, it's too expensive, even for an insurance company who's going to have to pass through the cost to have a really safe annuity. So I kind of disagree with Zvi that the more we index, the more we make it completely safe, we have to pay for that safety. And safe assets are very expensive. Yeah. And there's no way to get around that safe assets are expensive. So you only want to buy what you really need. So, I mean, I've personally argued that you don't want to sell these to everyone because Social Security is an annuity. Medicare is kind of an annuity. Owning your house gives you an annuity of housing services. So not everyone needs another costly annuity on top of that. So this is, again, a thing where we need our financial advisors to be more sophisticated.
And actually, to that point, you mentioned a number of things in the total kind of portfolio. So you mentioned housing, health,
Medicare.
Medicare. I don't know of any commercially available analytic tool or any advisor that puts together the entire portfolio. Right. So that makes giving the advice, even thinking about it the way Debbie set up, it's a challenge. And
I have another couple of questions, but we're going to open it up for questions in just a minute or two. So, and I'll start calling. But I just want to ask you, Greg, another area where there's been a lot of controversy, because you've talked about the governance issues and how, like Tennessee and Utah, Wisconsin,
right,
have stable systems. There's this whole controversy about what rate of return to assume, and I got to ask you.
Yeah. Well, so anybody who's been close to the issue knows there's a lot of argument about the discount rate, which in public sector pensions still averages between 7 and 7.5%. which is not a risk-free rate for anybody who's keeping score. I would say as a practical matter, if the desire was to flip a switch and have discount rate, risk-free rates be used in GASB filings, that process follows the practice of what the actuaries and the plans do. And we had a conference actually at the Harvard Kennedy School last year, and I think the GASB people are doing their job, and they walked us through, that's about a 10-year process. So change has been made recently, and so just pointing out that flipping that switch is really difficult. I will say that there's the opportunity and the ability now, though, to include that in the analysis that's out there for public plans in two ways. First off, some of the actuarial standards actually speak to this. I won't get too far into it, but there's a standard 51 and some proposed revisions to number 4 that essentially allow, if the sponsor chooses to do so, to publish the numbers based on that rate. And then the second thing I would say is, as practitioners, we're big advocates of stress testing. Again, we've developed a model and applied this to about 20 jurisdictions now. It's based on the same scenarios that Dodd-Frank uses. We apply that to actuarial projections. And we find that this is absolutely not an academic exercise. It's helped to shape and frame reforms in Colorado and Connecticut. It's been used to point out these risks of insolvency in other jurisdictions. And it's also the tool that shows us just how resilient a state like Wisconsin can be. So I think the controversy is well understood. I think doing analysis and publishing the numbers in different ways is possible now. But because flipping that switch is sort of a decade-long process, and we're much more focused on analysis that asks the question, what if the rate is wrong, as opposed to debating about the rate.
Okay. Debbie?
So I've been really, I am Ms. Discount Rate, so you got me on my hot button question. It is not a decade-long process. It's a decision of rulemakers on what they're going to do. So it's a travesty that they're using a 7.5% rate of return. It highly understates the liabilities. There's a professor at Stanford named Josh Rao who actually states them on an economic basis. And if you look at the underfunding on that economic basis, it's much scarier. So, but I myself have written a proposal that I think is kind of moderate, which is to say for financial reporting, they absolutely should report the truth about the liabilities. What hasn't completely happened, so the reason it's so stressful is because there's no distinction between the financial reporting and the funding requirements. So if all of a sudden you change the discount rate and all of a sudden your underfunding doubled, then by the rules you'd be required to double your contribution rate, and where would that money come from? So people are petrified that they don't want to see those rates go up. But there's actually no reason that you would need to have a sudden jump in the funding rule. You could smooth that, but still have the disclosure, because just in terms of a matter of transparency, they could switch the disclosure overnight and it wouldn't be a burden on anyone, because people are in fact creating that. And the ratings agencies are already doing it too. So Moody's will do the algebra of getting you to using a more reasonable discount rate. So it kind of is out there already. So I feel very strongly they need to change it. In fact, though, I'm happy to say that actuaries, I've been having this debate probably for 20 years with actuaries, and the actuaries used to be just adamant about not using a kind of an economic discount rate.
Yeah.
They've really changed their tune, so it's very heartening. And the law has started to move in this direction too. So I'm actually optimistic it's just a matter of time until things change.
Yeah.
So,
Greg?
Oh, I just want.
go ahead.
In the greatest of spirits on this, I just wanted to respond. I was mistaken about the 10-year process that we got walked through. I think it was actually 12 years. And I'm not even kidding. They walked us through all the steps it would take to follow convention. But to your point, Deb, I think the actuarial standards actually have evolved.
Right.
And I made reference to 2 that allow for these kind of calculations. And so this is a bit of a retail approach. But at Pew, we have been working with 7 states now to adopt stress test requirements. We've established the standard foundation for risk reporting, and it actually calls for that calculation. The actuaries call it an investment risk defeasance measure. And so if you look in the public reports, Hawaii is one good example. We've also worked on this with Connecticut. We're working with Pennsylvania. They actually have that disclosure. It's not so easy to find.
Well, actually, the law has changed.
Yeah.
So in an odd way, this is the weirdest thing. The actuaries decided that they had to go to a market value discount rate, but only if you were horribly underfunded. So it's this double whammy for them now. So they do disclose if things are terrible. I mean, that's the change in the rule, which was,
That's the
that
change
was the
in-
Gatsby change.
that's the change in the Gatsby
and people
change.
were very shocked that that was what they chose to do. So if you think things are bad, now look, they're even a lot worse. But we're not going to show you the path towards the, well.
Yeah.
Yeah, so,
And Kurt?
I think Debbie actually put a finger on the big issue, which is, I mean, the arithmetic has been out there for a long time. I mean, you know, I think when we talked about this the first time, we had maybe an hour blocked out to talk, and after 30 seconds, we had the discount rate thing done. It's like, okay, now what are we going to talk about? Because economists are going to agree on it like that. But the issue is the political one, which is how do you get this is something Greg brought up earlier, how do you get the enforcement so that people actually put the money in? And it's been far too convenient for public officials and union officials to simply say, you know what, we're going to keep the target return constant, even though risk-free rates have gone way the hell down, because that basically masks how much money has to go into the system. And I can guarantee you, if some state decided, oh, well, you know what, we want to get this completely off our books, we're going to go approach an insurance company to take it off the books. The insurance company goes, okay, fine, here's how we're valuing it. It'll be a market discount rate, and they'll ask the state for billions of dollars to make it fully funded. So you know, that's just how it is.
Well, I'd like to open up for questions, and if you're comfortable, please identify yourself, and my only requirement is that we ask questions. This is at Washington, D.C., speeches are common, but we'd like to get to as many questions as we can. And start here, sir.
I should apologize. My name's Eddie Eiches, and I should apologize at the beginning because this is a layman's question and may have some comments, but it seems like to me that from the perspective of what the best pension program is, it's got to help, you know, support the worker and support the business or entity or government. And my career was as a union president, God help us. And in the private sector, quite frankly, when you look at the numbers, the unions are in fact all defined benefit plans. And one of the problems, at least I've seen with defined benefit plans, is this tiering. You know, with GM, there was, you know, we all believe in equal pay for equal work, but if the pension is part of the equal pay and you tier it, you've destroyed morale. And one of the benefits of a defined benefit plan for employers is that people stay on. You don't have what's taking place right now where younger or people who just joined leave. So you have to find some kind of mechanism, I think, to have this defined benefit plan that won't cost a fortune. I mean, that is, won't lead to all types of liability. It also seems to me that when you have the defined benefit plan, you can pay much, much less. And that gets into the equation as to how you attract people who actually want to have some kind of lifestyle, who actually may very well be willing, with the incentive, to stay on, you know, as to the entity they're working for, get paid less, but have this defined benefit plan. And finally, on some level, we have an implicit annuity plan, which is called the required minimum distribution.
Okay, that's a pretty good set of questions there. So thank you. Kurt, Debbie?
So there's a lot there.
Yeah.
So let me start with some pieces. So let me start with the first one about the promise to the employee. So you're right that with a defined benefit plan, the employers basically, in some senses, obscured the cost of the retirement income. In other words, it's not transparent to the employee what's going on. So versus with a defined contribution system, so you can take different sizes. So you could argue, well, with the defined contribution system, if the employer basically says, I'm paying you X dollars, and I'm paying you plus X, and the plus X is your going to the defined contribution system, that the employee gets more transparency in terms of what's actually going into the total compensation package. And again, what's that phrase, beauty's in the eye of the beholder. So given the way the world is now, with people being much more mobile in the labor market, there's some attraction to that for possible attraction of that for employers. So I think there's kind of two sides of it. But the point about saying, well, okay, we want to be kind of think about the total compensation, that I totally agree with. It's just you got to get more transparency in the components.
Anything to add, Debbie?
No, it's tricky about what people want. I mean, I guess I'm just going to say the same thing you did, which is there's been a move away from DB, and you don't see basically any younger firms offering DB. And I'm sure they are thinking about what minimizes their total cost of compensation. But at least when you look at studies of how young people discount the future, they discount them at a higher rate than the rate of return that you probably need to get to make it feasible. So I actually think they might be short-sighted, but I think in the modern world, it's just not happening. And also, I think an interesting historical note is the reason pension plans came in the first place wasn't to retain workers, but to get rid of older workers so that they would have a place to go. And, I don't think that that's probably the most effective way to retain workers in the modern era. In fact, you'd have to give them a more portable benefit. That was the attraction of the 401k.
Greg?
I just want to acknowledge that's a really good point about tiering. Right? It should be equal pay for equal work. And what has happened in the public sector is that the tiers have gotten progressively less generous.
Yes.
And that's unfair and kind of uncool. And actually, in the extreme, Deb, you were bringing this up before, when you're thinking about the model, right, there's a temptation to not give the employee contributions to people who leave, and that's exactly what's happened. So younger workers don't realize it, but they're not getting a benefit that's doing very much for them. I think that's just a really good point to bring up.
Here.
What is the role of longevity risk? It's been pretty much a one-way street, ever higher, but maybe that's changing. But just wanted to know how that impacts the kind of analysis you're doing.
Debbie?
Me? Well, the role of it is that it's interesting to sit in a room full of demographers. I don't know if you have, but they are worse than I felt good because for a change, I was not just the only profession who didn't have agreement on what the world was. So I think there's huge uncertainty about longevity risk, but there's also, there's an interesting also distinction between how long will people live and how healthy will they be. So that really changes the options for how long people can work, because I do think that you are starting to see people both thinking they're going to work longer, and some of them are working longer, but though not as much as they will. So it is, it's clearly a big risk. It gets priced in by actuaries, but I think the uncertainty bounds are really large. And that also gets back to the question of how do you advise people in terms of what they do. I think it is a reason, in fact, that people should have some annuity income, and I think people need to be educated about that. I think a lot of people are pessimistic about their own longevity, and they should also realize that they might not think they're going to live for a long time, but they could, and they should prepare for it.
Yeah. But also, wouldn't you think that, that's one argument, maybe the best annuity is working longer, so you delay filing for Social Security as long as possible, right? Because it's till age 70 at least, and then start looking at other alternatives after that.
Yeah.
Right, and that works for some people and not for others. So Social Security at least aims to be actuarially fair, at least on average, but it's well known that, for instance, for male minorities should not delay claiming because statistically they don't live that long, and so actually they would be better off. So I think people give that advice, but it needs to be a little bit more nuanced because it's not the right advice for everyone.
They're over here.
I don't know if I need this mic, but anyway, this relates to the longevity question. I gather you don't like the HUD reverse mortgage program. Now, is that because it's 30 years ago when they developed it, they didn't think people were going to live so long, or is it fundamentally unsound in some other way?
So I am a big proponent of developing a good reverse mortgage product. I basically feel like credit programs are the things I think about in life. They go with my discount rates. And so actually that reverse mortgage program brings together the worst of everything I've ever seen in a government program. So the way it works is that it's intermediated by the private sector. So it's called a guaranteed loan program, which is in contrast to a direct loan program. So in the case of student loans, the government switched from using private intermediaries to lending directly because they were cutting out the middleman, so to speak. So in the HUD reverse mortgage program, there are these middlemen. There's nothing that compels them to be transparent. So if you were shopping for a regular forward mortgage, you could at least go to LendingTree or something and get a sense of what was there. Give it a try. I'm recommending it. Just go out there and say, I'd like to get a reverse mortgage. You cannot get information without talking to someone. The products are extremely complicated. So I've simulated out the program, and the bottom line is just the cost is incredible. And what kind of bears that out is that the only people who have used them a lot, at least historically, my friends who do reverse mortgages who are in the business tell me, oh no, it's gotten much better. But at least historically, low income minorities, people in communities where they saw kind of a windfall gain in their house value in the run up prior to the financial crisis, actually got these things sold to them, and they don't have access to a lot of other financial products. But they're a very expensive financial product, and the government is actually taking all the risk, because as soon as the balance of your reverse, so the way it works, for those of you who don't know about reverse mortgages, is say that you have $100,000 of equity in your house, you can take out, say, $50,000, and then you don't have to pay it back until you sell the house or move out of the house, but interest accrues. So you can only pull out, say, $50,000 because there has to be space for that growth of interest and fees. But the interest rates and the fees are very high. That's what I'm arguing. And I believe that's because of the market structure, which is supported by the government, that basically doesn't create a lot of competition. So I think there's a way of creating a product that's a much more reputable product that doesn't have late night ads on TV from aging celebrities. I mean, why do you need to do that? Tom Selleck does not need to sell the reverse mortgages. So I think it's a potentially extremely important product, but given that the government is absorbing all the risks. So as soon as they hit the kind of guaranteed max, those loans get transferred back to the government anyway. And that's why the government they've lost a lot of money on them, but that's beside the point. I mean, it's a messed up program. I hope that's helpful.
Great.
Good.
Len Berman, another messed up insurance market you didn't talk about, but it's relevant to people who know it, is long-term care.
Yes.
Also, not enough insurance,
Absolutely.
not enough competition, and very high cost, big problem of adverse selection. It seems like, I guess I'm asking this question, is there like, I guess I'm making a suggestion, I'm going to ask you what you think of it. I mean, it seems like this would be a role for economists to talk about reforming the whole market of insurance products relate to older people, annuities, reverse mortgages, long-term care insurance, all the other things I'm not aware of. Are people thinking about that? Is there some way of fixing these market problems? And also, are there ways to get people into annuities and long-term care insurance before the adverse selection problem is too bad, so presumably you can get them at lower costs?
May I?
Please.
Yeah, so long-term care insurance is the other big issue, and I agree with you 100%. It hasn't really been dealt with. There's some innovative proposals to mix long-term care and life or reverse, so some of these are offsetting risks, and there, as you just said, there is the thought that maybe you could design a product where you reduce the total adverse selection by having these things packaged together. So I think that's a very promising kind of way to go. But as you probably know, long-term care insurance, people have been talking about it for decades. first was working on it, I worked on it in the early 90s, and people would basically laugh me out of the room, like, why would you ever need a product like this? And it's been a hard product too, because I'm sure you know, Medicaid provides a lot of long-term care, so you do have all these selection issues. Yeah. It's a huge issue.
What the risk is,
Yeah.
because it's hard to keep the medical costs 2 years down the road, much less 20 or 30.
Yeah.
Right. I mean,
How do you build a long-term insurance product on a broken system?
Right.
Yeah.
And I think the number, what you would know, in the 90s, there were at least, though, I think there were 100 insurance companies selling it, and the last time I looked, you're down to about 12. And of those 12, only a handful actually are in the market. I mean, the other ones
Writing
say
the
they
policies,
are.
yeah.
So it's really
Right.
shrunk.
And all these products actually are very difficult to sell because people are worried about abusive consumers. So I just want to say that both reverse mortgages and long-term care suffer from the problem. So the reverse mortgages in particular, the optics of kicking the relatives of old people out of the house who don't actually have a claim there. So, you know, the private market has really pulled back. As in many parts of the mortgage market, traditional banks have gotten completely out of the business. And what you see is specialty reverse mortgage companies that don't have as much reputation to lose through the product. So it's very complicated to create good markets for all this stuff.
This question comes from a Minnesota graduate who had one economic course 50 years ago from Walter Heller in Northrop Auditorium, and I think there were like 500 or 1,000 students in the class. So you can imagine how much we learned. My question is this: as a society, how do you assess our retirement literacy? Are we doing enough to prepare people for the realities of the marketplace and retirement and the changing society we live in? And if so, what can be done? Is anyone doing any interesting work at our schools and our high schools or wherever to increase literacy and understanding of these issues earlier when you can actually do something about them?
So I can start.
Yeah,
I
that
know
sounds
Greg's thought about it. I think so we all thought about it. So to your first question, no. Not much has been done historically. Most people, I would say, and you know, I think people, well, I'm pretty sure most people approach retirement and they're kind of confused. On the high net worth segment, people count on their advisors to help them. I think we've already talked about that. There have been a number of states that have started programs, including Rhode Island is looking into starting a program on financial literacy. Although I understand that the effectiveness is not particularly good. I personally would rather see more default options, but that's just one man's opinion on that.
Great.
This is a little out of scope for our project, but I would agree with what Kurt just said. Is I just don't know how far you can go with literacy, and just wonder if instilling in people the understanding of a certain level of savings when they can get there earlier in their career, postponing Social Security for as long as they can, and maybe 2 or 3 really smart decisions you can make. But again, I think to Kurt's point, these idea of having a better designed system that makes default decisions for people because they're not experts, I think is more probably where the focus of this conversation is.
Debbie?
Well, they do need to be educated to save, though. I mean, I don't think it's so much. I mean, the main problem is people haven't saved enough. That's the elephant in the room, and the rest of this is kind of a rich person's problem. But I also want to put in a plug for. I mean, I think there are some efforts. There's one I'm particularly tuned into, which there's something called the Council for Economic Education. It's run out of New York, and they're trying to get financial literacy at a younger age, and they're training teachers all over the country. My friend Nan Morrison runs that organization, and they're doing a really good job, and they could use support. Of course, they're not doing as much as they could, but I think I agree that we give so little basic economic education. Even like in our math curriculum, we could put in more finance problems at younger ages. Just if you're going to teach people math, you might as well teach them some economics, but we don't usually.
They can do compound interest.
Yeah, they can do compound interest, and they can start saving earlier.
That'd be a start.
So it's related to this latest question. There seems to be some market failure from the fact that young people are not internalizing the cost of not saving. Is there any state that has undertaken a reform that has some age-dependent tax breaks depending on how much you contribute to incentivize basically young people to save more?
I don't know of anything like that.
Well, I might dispute that they're not saving enough. So, I mean, I agree with the observation, but the question about is it enough, I think that's a different thing. So you could sort of say, well, I mean, at least as I read the life cycle models, it is optimal to not save a lot when you're young and then jack up the savings as you hit your prime earning years. So what we see is, well, they're not saving enough, but it might simply be the result of kind of the internal optimization problem. Not that I think every 25-year-old is walking around solving dynamic programming problems, but it might just be kind of a rational response.
Yeah.
Now that said, what DC systems like Australia have done is they basically said, look, here's the default contribution to your DC program, which is a way to kind of get it, people saving early.
And what do you think of the idea? I mean, a number of countries have adopted mandatory retirement savings systems. Australia, Britain, and Israel. And it looks like it's achieved its goals.
Well, okay, so I think it's actually solving a different problem, which is a moral hazard problem. Because no one really wants to sort of say, oh, gee, this cohort of people, they can't live well in retirement. But and by the way, I don't think that's bad, just to be clear.
Right.
But let's label it what it is. It's solving a moral hazard problem, not an actual finance problem. I mean, the finance problem will be, okay, here's the life cycle, this is what you do. Okay, well, suppose people get a bad draw from the distribution. Well, then it doesn't look so swift. And the moral hazard thing is, well, okay, so if they get the bad draw, we don't want them to be totally screwed. So we want to have them start saving early. But it's solving a different problem.
So,
I think it's a good thing, by the way.
What strikes me is none of us are talking about Social Security, but that's the highest tax for most young people. And the income, it's a very regressive tax in the sense that it's capped and flat. And young people pay a lot of Social Security taxes. And personally, I think something we also don't touch on in this conversation, maybe because it's not fashionable these days, is that it's also an income distribution question. So, I mean, my personal feeling is I would rather see Social Security increased for poorer people, because I think that saying that people who are on the low end of the income distribution should be saving more is unrealistic and wrong. And I mean, we have, well, that's just so that was just an editorial opinion. Other people could disagree, but I mean, the point is that these things very much have to do with income distribution, and to just say that all young people should save or something, it just seems crazy.
Well, I actually agree with you, and then as long as we're like, you have the elephant in the room, people aren't saving enough.
Yeah.
Well, I mean, at a certain level, it's not just a savings problem. It's what's going on with income growth.
Right.
Yeah.
And that's the problem with that it's people who deal with pension stuff. It's like, okay, that income thing, that's over there.
Right. And yet that's
But that actually is the elephant in the room.
That is, exactly.
Right. I mean, because people are talking about a universal basic income. And so that Social Security is a universal basic income for old people. And, if there was a universal basic income, that would also help old people. So I think these things are all more connected. But it's hard to talk about the whole population. I like that you always say, well, the rich people are fine and they do this.
Yeah.
And then, but we also should recognize we're not talking about the lower third or something, because there is no savings.
Well,
and so there needs to be a conversation about that too.
And as long as you brought that up.
Okay.
So if you look at the entire asset management business, it's not really set up for that group of people. It's entirely, all the incentives are geared towards either institutions with defined benefit programs, or they're geared towards the high net worth segment and kind of slightly below. So now we've covered, I don't know, 30% maybe of the population. What's everybody else supposed to do?
And reinforcing that was that, there's 350 financial planners in a room, and they were complaining about young people.
Yeah.
And they're not saving. But you sort of ask a couple questions, and what it is they're not saving in retirement savings plans that we can manage those assets.
Correct.
And what they should be telling the young people, because young people also change their jobs a lot earlier in their careers, if you have savings, it should probably just be in a savings account. But they don't make any money off savings account.
No, exactly.
Yeah. Sir?
Hi, thank you. I'm intrigued. I'd like to bring up the topic of emergency savings, which seems to set a lot of people back when something happens. And basically, we go around with just rules of thumb. You should have 3 months. That sounds like a lot of money to a lot of people. And the famous, the one economic quote that seemed to make it in the last presidential election was that Fed statistic that if confronted with a $400 emergency, most people wouldn't have, right? And so I'm interested if there's research going on, and especially maybe to you about if you're so interested in credit products. I'm always intrigued, what is the appropriate product for someone to park their emergency savings?
I don't think so.
I'm not even trying to understand the question.
I'm sorry, what's the,
So is a question about the emergency savings and where to put them, or how much you need to have?
Second part, yeah, generally. But I'm interested in this interaction between it preventing you from actually trying to save.
Yeah.
And because those shocks tend to keep people back.
So this isn't answering the question head on, but I think what that's prompting me to remember some of the research, the lockbox research, this is Madrian, Lapes, and Choi, where they've been thinking really hard about your question to some degree, but in the context of retirement savings. And I think what we found really interesting about that is they do an optimal model for how much you should be essentially working towards annuitizing and how much you should have available for emergencies, essentially. And I think they come away with a solution, at least the way that we look at it, that is something like a three-legged stool of Social Security, some form of annuitized income, which in the public sector could be a defined benefit plan, and then an individual savings account. And the individual savings account is actually pretty substantial. I think what's interesting about that is when we talk about annuitizations and annuities, it comes to my mind that there's regulatory challenges with it. The low interest rates is a challenge, and then we have human behavior. And so I think this idea of allowing people to think about their retirement savings in different buckets, including one that they can access at any moment in time, is sort of a way to get over the human behavior hump. Because we all love to split the baby, and this analysis kind of showed that actually might be an optimal way of doing it. So that idea of having a defined contribution account where you might maintain some level of your retirement savings, I think really resonated with me, and it resonated with how some of these well-established plans have actually been set up, if that helps.
And I am curious, so I was talking with a man from the Netherlands, and he had helped set up a pension system in Ghana, and went to the market, and of course the thing is, people don't have much money, but what they did is you could withdraw the money at any point. So it actually became, in a sense, retirement savings and emergency savings became the same. And I think there's some incentives to keep it in there. But there were two things they did. One, it was being managed out of the Netherlands, so there was a trust issue there, a good trust issue there. But what they found that succeeded with cab drivers and in the market was, yes, you can put money in here and we'll manage it. It's going to go to your retirement savings. But if you have an emergency, here you go. And it's on your cell phone. And I'm curious, in your research, has that sort of, I mean, typically we talk about you shouldn't touch this retirement savings. We've got to put as big of barriers as possible there, although you can take loans out against it. But does that sort of idea, does that resonate or not?
Well, so with me personally, I feel like we've put too many barriers for people to get at their retirement money. So I'm not a behavioral economist, but the research he was just quoting, they tend to want a lockbox because they don't trust people to control themselves. I guess I have more faith in people. I think it's actually a deterrent to retirement savings when people can't get at the money, because if they know they're going to have an emergency, why would they tie up their money? And even though you can borrow against it, it's not easy. I guess one other thing I'll mention is the reverse mortgage is actually a good feature of the program is that you can take it out as a line of credit and not draw on it. And so it actually does provide emergency funds. So you could imagine that older people who had most of what they have is covered, but all of a sudden there's a health emergency or something, they could draw on the house then. So that is at least another, you were asking for other assets, and so you could draw on your home equity. Or a HELOC. A HELOC will do it too. And a HELOC is actually much more economical than a reverse mortgage. The only thing the reverse mortgage has over the HELOC is the HELOC starts having to be repaid right away. So with someone with no income source, it's harder to manage.
One more question?
Eva Francisco. So if reverse mortgages are so bad, why don't we see more people just selling the house and downsizing to smaller apartments and just managing, all their savings? Because most people save in a house, really. Like when you look at sort of consumer finance data, the median value of a house is 3 times their retirement savings.
Well, as a card-carrying member of the baby boomer generation, we are doing that.
Yeah.
My generation is doing that.
Yeah.
So selling houses. What's that?
They do it a lot. So what I should say is people are doing that, and reverse mortgage is really meant to allow people not to do that. So when you survey people, a lot of people don't want to move anywhere. And in fact, there's some evidence that, so a lot of the people who get a reverse mortgage have actually already downsized once, and then they've bought something smaller, and then they kind of want to stay put. So just nursing homes are bad for people, and they're very expensive. And so there is some evidence that allowing people to age in place, if they can, is better for them and less expensive for the system. And in fact, some people talk about reverse mortgages as a way of funding some home care. So you want to stay in your house, but you don't really have the income to do that. So it has, I'm not trying to be a seller of the product, but I do think that just younger people tend to say, well, why don't you just sell your house and move? But that's very disorienting for people once they reach a certain.
So I want to ask a last question, and we're in Washington, D.C. So on the policy side, before we have our drinks in the back, on the policy side, what would you like to see policymakers focus on? I mean, we've covered a lot of ground. This is obviously, there's a lot to talk about. It's a complicated topic. But what would you like to see? We'll start with you, Kurt. What would you like to see, or what do you think, here's the key issue for policymakers to focus on that can actually make a difference?
So the big one for me would be getting more default options. Actually, I'll give you 3.
Yeah.
So the first one is encouraging better savings. The second one is encouraging better advice. So kind of dropping some of the regulatory barriers for people to give advice. And the third would be to take a really hard look at what the barriers are for the annuities market. Not that I want to turn into Zavi, but that would be my third.
Okay. Debbie?
I guess I would also say, well, I'm also in the realm of the doable. So in the realm of the doable, harmonizing regulation to make it easier. So for instance, not to keep on harping on reverse mortgages, but they're regulated as a mortgage product, not as a retirement product. And apparently financial advisors can't really talk about them. And so there's these just small barriers. I think long-term care insurance is something else that doesn't really get discussed with the whole package that much. So I think just thinking about what are the institutional barriers that are making it hard to move towards a more integrated system.
Greg?
Harmonizing regulation in a way that allows state-level innovation.
Yeah.
I think that would be my answer to that. I love that phrase, harmonizing regulation. We all know it's spaghetti wire, and it's challenging with ERISA and the DOL and IRS. But there also are some innovative things happening at the state level. And so harmonizing it with that in mind, as opposed to a federal solution that I think is just hard for us to get our arms around, that would be my vote on that.
Well, thank you very much. And Deborah Lucas is Professor of Finance at the MIT Sloan School of Management. Greg Mennis is Director of Public Sector Retirement Systems Research for Pew Charitable Trusts. And Kurt Winkelmann is Senior Fellow of Pension Policy at the Heller-Hurwicz Economic Institute at the University of Minnesota. So I also want to, as in a close, I want to thank tonight's co-sponsor, Arnold Ventures, for helping to make tonight possible. And most importantly, thank you for attending. And then I have been given the pleasant task to say, please join us at the back of the room to continue this conversation at the reception. Thank you.
All right. Thank you. Thanks, man. That was fun, as always.
Yeah, thank you.
Yeah.
Thanks, guys.
We'll have to get you to come to Boston sometime. Do you ever come?